For the first time in U.S. history, the U.S. national debt just surpassed $35 trillion.
$35 trillion in debt. That's $104,000 per American.
As the world becomes increasingly interconnected and complex, the potential for significant economic disruptions grows. In the United States, various underlying issues have been identified as potential economic time bombs, ticking away, waiting to explode and cause widespread financial fallout. These include escalating national debt, housing market instability, looming pension crisis, income inequality, and the specter of another financial crisis. In this video, we examine these economic time bombs, provides relevant data and studies from 2024, and discusses how individuals and policymakers can prepare for and mitigate the impact of these potential financial disasters. National debt crisis. The United States national debt has been growing at an alarming rate. As of 2024, the national debt has surpassed $35 trillion, up from $28 trillion in 2021. This represents a debt-to-GDP ratio of over 130%, a level that many economists consider unsustainable in the long term. The primary drivers of this ballooning debt include persistent budget deficits, extensive government spending on social programs and defense, and tax cuts that reduce federal revenue. The COVID-19 pandemic exacerbated the situation as the government implemented massive relief packages to support the economy. A burgeoning national debt can lead to several negative consequences. High debt levels may lead to increased borrowing costs as investors demand higher yields on government bonds to compensate for perceived risk. This can crowd out private investment, slowing economic growth. Additionally, the government might be forced to cut essential services or increase taxes, which can stifle economic activity and reduce the standard of living. Housing market instability. The U.S. housing market has shown signs of instability in recent years. In 2024, the median home price in the United States reached $450,000, a significant increase from $330,000 in 2020. This rapid appreciation has raised concerns about affordability and the potential for a housing bubble. Several factors contribute to housing market instability. These include low interest rates, which make borrowing cheaper and drive up home prices, and limited housing supply due to regulatory constraints and supply chain disruptions. Additionally, speculative investment in real estate has increased, further inflating prices. A housing market correction or crash could have severe repercussions. Homeowners might find themselves with negative equity, leading to increased defaults and foreclosures. The financial sector, heavily invested in mortgage-backed securities, could experience significant losses, potentially triggering a broader financial crisis similar to the one seen in 2008. Looming pension crisis. Public and private pension systems in the United States are under significant strain. As of 2024, the total unfunded liabilities for state and local pension plans exceed $4 trillion. Many pension funds are struggling to meet their obligations due to lower than expected returns on investments and an aging population that increases the number of beneficiaries. The primary issues include inadequate funding contributions, overly optimistic assumptions about investment returns, and demographic shifts with more retirees than working-age contributors. Additionally, some pension funds have taken on excessive risk in their investment portfolios to try to bridge funding gaps. A pension crisis could have wide-ranging economic and social implications. Retirees who rely on these pensions might face significant reductions in their benefits, leading to increased poverty and reduced consumer spending. States and municipalities could face severe budgetary pressures, potentially leading to higher taxes or cuts in public services. Income inequality. Income inequality in the United States has been rising steadily. In 2024, the top 1% of earners accounted for nearly 40% of the nation's wealth, while the bottom 50% owned less than 2%. This growing disparity is a source of economic and social tension. Several factors contribute to income inequality, including technological advancements that disproportionately benefit high-skilled workers, globalization that has led to the offshoring of many middle-income jobs, and a tax system that some argue favors the wealthy. High levels of income inequality can lead to social unrest and reduce economic mobility. It can also stifle overall economic growth, as lower-income households typically spend a higher proportion of their income than wealthier households. This reduced spending can lead to lower aggregate demand and slower economic growth. Financial crisis threat. The global financial crisis of 2008 left deep scars on the U.S. economy. While regulatory reforms, such as the Dodd-Frank Act, were implemented to prevent a recurrence, vulnerabilities remain. In 2024, the potential for a new financial crisis is still a concern. Several factors contribute to the risk of another financial crisis. These include high levels of corporate and consumer debt, financial market speculation, and the potential for a rapid rise in interest rates. Additionally, the growing popularity of cryptocurrencies and decentralized finance, DeFi, presents new, poorly understood risks. A financial crisis could lead to widespread economic disruption, including severe market downturns, bank failures, and a sharp increase in unemployment. The interconnectedness of global financial markets means that a crisis in the United States could have severe repercussions worldwide. A 2024 study by the Congressional Budget Office, CBO, projects that if current policies remain unchanged, the national debt will exceed $45 trillion by 2030. The study emphasizes the need for comprehensive fiscal reforms to address the structural deficits driving this debt. Research by the Federal Reserve in 2024 indicates that while housing prices have surged, the market shows signs of cooling due to rising interest rates and increased construction activity. However, the report warns that a sudden economic downturn could still trigger a significant correction. The National Institute on Retirement Security, NIRS, released a 2024 report highlighting the critical condition of public pension systems. The report calls for immediate action, including increased funding contributions and revised assumptions about investment returns to avert a crisis. A 2024 analysis by the Economic Policy Institute, EPI, shows that income inequality continues to grow, driven by wage stagnation for low and middle-income workers and rapid income growth for the top earners. The report advocates for policies such as raising the minimum wage and strengthening labor unions to address this issue. The Financial Stability Oversight Council, FSOC, in its 2024 annual report, highlights several risks to financial stability, including high levels of leverage in the corporate sector and vulnerabilities in the non-bank financial system. The report calls for enhanced regulatory oversight and risk management practices. Preparing for the financial fallout. Individual preparation. 1. Diversify investments. Individuals should diversify their investment portfolios to mitigate risk. This includes a mix of stocks, bonds, real estate, and alternative assets such as precious metals or cryptocurrencies. 2. Build an emergency fund. Having an emergency fund equivalent to at least 6 months of living expenses can provide a financial cushion in case of economic disruption. 3. Stay informed. Keeping abreast of economic trends and understanding the potential risks can help individuals make informed financial decisions. 4. Reduce debt. Paying down high-interest debt, such as credit card balances, can improve financial stability and reduce vulnerability to economic shocks. 5. Plan for retirement. Regularly contributing to retirement accounts, such as 400 and Onyx or IRAs, and understanding pension benefits can ensure long-term financial security. Policy recommendations. 1. Fiscal responsibility. Policymakers need to address the national debt through a combination of spending cuts and revenue increases. This may include reforming entitlement programs, reducing wasteful spending, and implementing tax reforms. 2. Housing market regulation. Strengthening regulations to prevent speculative bubbles and ensuring adequate affordable housing supply can stabilize the housing market. 3. Pension reform. Addressing the pension crisis requires realistic assumptions about investment returns, increased funding contributions, and potentially raising the retirement age. 4. Income inequality measures. Implementing policies such as progressive taxation, increased minimum wages, and support for labor unions can help reduce income inequality. 5. Financial sector oversight. Enhancing regulatory oversight of the financial sector, including emerging areas like cryptocurrencies and DeFi, can mitigate the risk of another financial crisis. The 2008 financial crisis serves as a stark reminder of the potential fallout from unchecked economic risks. Triggered by the collapse of the housing market and the subsequent failure of major financial institutions, the crisis led to a severe recession, millions of job losses, and significant government interventions. The crisis highlighted the need for robust regulatory frameworks and the importance of financial stability. In 2013, Detroit became the largest U.S. city to file for bankruptcy, driven by decades of economic decline, mismanagement, and unsustainable pension obligations. The bankruptcy led to significant cuts in public services and pension benefits. Detroit's experience underscores the potential consequences of ignoring fiscal realities and the importance of proactive financial management. Ultimately, the United States faces several economic time bombs that, if left unaddressed, could lead to significant financial fallout. From the growing national debt and housing market instability to the looming pension crisis and rising income inequality, these issues require urgent attention from both individuals and policymakers. Recent data and studies from 2024 highlight the scale of these challenges and the need for comprehensive, forward-looking solutions. By diversifying investments, building emergency funds, reducing debt, and planning for retirement, individuals can protect themselves against potential economic disruptions. Policymakers, on the other hand, must implement prudent fiscal policies, strengthen regulatory frameworks, and address structural inequalities to ensure long-term economic stability. As we navigate the complexities of the modern financial landscape, the key to mitigating the impact of these economic time bombs lies in proactive planning, informed decision-making, and a commitment to addressing the root causes of these systemic issues. Only through collective effort and vigilance can we hope to defuse these time bombs and secure a stable and prosperous future for all.